Okay, are you ready? We are counting down to the live market reaction to the very important US inflation data coming up in less than half an hour from now. And we're going to show you how markets are going to react to this data. And of course, in the lead up to it, we'll explain to you why it's important and, why why it's important and how markets might react. Okay, sorry about that. Yeah, let me just go straight to some charts here. Now, if you have been following us, we have been looking at Euro GBP since last Friday. This is a currency pair between the euro versus the British pound. I'll show you what the chart looks like right now. All right, there we go. So while you're keeping an eye on this, I'm going to make sure that we do have confirmation. We are streaming live on YouTube. Our YouTube channel is Bybit Learn Official, and we are also streaming live on X. Our X handle is at Bybit_Learn. Okay. Again, our YouTube channel is you got to search for Bybit Learn Official. And then you tap on the live tab, and all of our previous live streams are all archived and published there in the name of transparency. And again, our X handle is at Bybit_Learn. Indeed, we are live on YouTube, so you can feel free to give me a chat there. I know, folks, that you have been chatting while giving me questions there. And, look, I got like 4 different screens I got to look at. So sometimes I'm a bit slow, but you can leave it in there and I'll try to answer them. If not during the live stream, then certainly, after the fact, you guys got to keep checking back in. Okay. I'm a lot more responsive on X. Again, that's at Bybit_Learn. And yes, we are live on Bybit Learn as well on our X handle. Let me just double check. Is the audio running? Can you guys hear me? Give me a shout out. Yes, we are. Yes. Okay, cool. All right, cool. So this EURGBP, all right? So now let me guide you guys back to the article that we have published even from last Friday. So if your starting point is Bybit.com, and don't worry if you are joining in via the Bybit app, excuse me, I'll tell you how to get to these pages in a bit. I'll just zoom in real quick. 1, 2, 3, 4. So if you're at Bybit.com, you'll see the Learn tab across the top, okay? And then you can click on Bybit Learn here in the middle. Let me try that again. So Bybit.com, learn, Bybit Learn. Okay, click on it. Sorry, we got to zoom fast here because we've got another big event coming up in about 10 minutes. That's the European Central Bank decision. So once you get to Bybit Learn, you'll see the URL change to learn.bybit.com, right? You can scroll down till you see analysis. Click on it, and you can see our daily bits, which we publish every single day. Okay, notice this one here. We highlighted 3 assets to watch for this week. All right, including gold, of course. But for now, because we've got the European Central Bank coming up in about 10 minutes from now, we had also highlighted the ECB decision coming up. So let me zoom in. So we've got 3 big events this week, as we had highlighted from last Friday. If you missed out, go and check it out now. So yeah. Excuse me, we had the jobs report just came out on Tuesday already. You can rewatch our live stream that we did just like today live, right? We showed you how markets reacted. To be fair, markets really didn't react much because they are thinking, well, this jobs report is dated, right? Keep in mind the inflation data coming out in about 25 minutes from now is also delayed because of the US government shutdown. Okay, typically the US jobs report comes out on the first Friday of every month. We just got it on December 16th, right? And then for the CPI, yeah, it's pretty usual. It's around mid-month, and I'll show you the dates of all the CPI, that's consumer price index, which is inflation. We'll show you all those releases that we've seen so far this year. This could be another nothing burger. We'll wait and see, but still, at least we are doing our due diligence. We are being responsible, keeping you informed about what could potentially move markets, because historically, this CPI day has been a big one for global financial markets. And I'll tell you why in just a bit. All right. For EURGBP, yesterday, we saw a big move in the British pound side because we got the UK's inflation data, that's CPI. And then coming up in about 9 minutes from now, we've got an ECB decision. All right. And then we've also, we already had the Bank of England rate decision just about an hour or so ago. Right. So What does this all mean for EURGBP? Let me get straight to the chart here and zoom back out and reset, right? You see these big moves here, right? Again, just to demonstrate that, hey, we told you guys big moves are incoming, right? But it's kind of going up, up, down, right? Monday, Tuesday, Wednesday, Thursday, right? So on Tuesday, we have the US non-farm payrolls data, which is the jobs data. Then we had UK inflation data that came in lower than expected. Hence, you got the weaker British pound. When the euro is strengthening against the weaker British pound, as the second half, you see EURGBP go up. Okay, that's how FX pairs work. As opposed to right now, you've got a British pound strengthening against the euro. That's why you've got the British pound, you got EURGBP going down. Okay, let me repeat. When EURGBP goes down, that means the British pound on the right side of the FX pair, the British pound is stronger against the euro, down. Okay, when the GBP is weaker against the euro, that means euro is getting stronger against GBP, up. Okay, that's how you interpret FX pairs. Okay, so now, I mean, we from last Friday, and you can see that from an article as well, we had highlighted this target to the upside and this target to the downside. Looks like we need a really big move here from CPI and between now and the end of tomorrow before going into the weekend for it to really hit either target. So you see, I've had some feedback, we've had so many of these targets actually hit, but guess what? It is not guaranteed. None of this is financial advice, right? I'm more of a fundamental guy. In other words, I need to know what's moving markets and why, and that gives me the rationale for why we draw these levels here and whether it can either go up or go down. In full transparency, then you have to take that risk, right? Whether it's going up or down. But we have a pretty good track record of many of these forecasted targets being hit. But again, none of this is financial advice. Please do your own research. So we're looking at the EURGBP because we've had the UK inflation data come out yesterday. We had the Bank of England already, even though they cut interest rates, right? Excuse me, going back to the screen. So even though markets had widely expected for them to cut interest rates, guess what? It was a close call. They only voted 5-4 in favor of the rate cut. That means there were about 4 people, or about half of the Bank of England's Monetary Policy Committee. That's the committee of the folks who gather together who actually vote on what to do with interest rates. That's the same with basically major central banks around the world, right? So given that 4 of them were doubtful about whether they even wanted to cut interest rates, that kind of told markets that, hey, maybe the British pound has to be stronger because future rate cuts may not be guaranteed, right? So keep in mind, here's how FX market works generally, okay? The idea of interest rates going down weakens the currency, okay? As opposed to the idea of interest rates staying high or going higher, it strengthens the currency. So when you compare the ECB, markets don't expect them to cut interest rates all of next year, not even today. Okay, as opposed to the Bank of England, I'll give you some live data now. Not only have they just cut, let's see where they're at, but right now markets are predicting. We have 5 minutes to ECB. Yeah, I'll keep you guys posted. And what Euro ECB. So markets now predict, about a 50-50 chance that the Bank of England might actually cut twice next year. Okay, so now this is pretty interesting because let's check it from, say, the day before. Well, it's actually slightly lower, actually. Yeah, so there we go. As opposed to the 68% chance that the Bank of England could cut interest rates twice next year, from 68% now down to live numbers about 50-50. So again, the idea that the Bank of England might cut interest rates more next year, maybe that's in doubt. Why? Because you had 4 people voting against the other 5. The 4 voted no cut this today, right? Let me just, in fact, fact check myself here on the Bloomberg terminal. We've got coverage. Yeah, close calls to come, right? So they actually, to be clear, they actually cut interest rates today. This is the Bank of England, right? But it was a close call. 5 in favor, 4 not in favor, right? So we'll have to wait and see. Yeah, so that's a Bank of England. So hence, no surprise, you've got, because of that, what's called a hawkish cut, you've got the uh, British pound actually strengthening against the euro, going down now. We're going to count down 4 minutes left until the ECB. So we'll keep monitoring that one there. Let me just make sure I've got everything set up on my Bloomberg terminal to give it to you live. And of course, you're watching EURGBP live right now. And then after the ECB, we'll quickly guide you into the US CPI data that's due out in 18 minutes from now. So told you it's going to be action packed, right? So hopefully, from this time, you can glean these learnings to make better informed decisions in the future, especially around the Fed decision days, the ECB, that's the European Central Bank, when on the days they make decisions, Bank of England as well. And we've got the Bank of Japan on Friday, and we wrote about that as well, right? So, see, you've got on Friday, not just the Bank of Japan rate decision, but also their national CPI, that's inflation data. Oh, maybe that's a bit too much. Sorry, where did it go? Yeah, here. Okay. So on Friday, we've got big big macro events happening as well. Okay. In fact, we wrote an article today focusing purely on what's happening, because hey, this is pretty much happening overnight, depending on where you're watching from. Right. So you got to be prepared in advance. But for today's events right now, we've already mentioned it from last Friday. So we gave you a heads up. Don't say we didn't warn you, right? So this is what's happening right now. This inflation data from the US coming out in 17 minutes from now. ECB coming out in about 2 minutes from now. So going back to the euro British pound chart, we'll see if there's a big move. And in fact, I'll zoom into the 1 minute chart and really zoom in. So see small moves right now, but we'll amplify it and see. We'll zoom in and see if there's a big move in 2 minutes when the European Central Bank actually makes their decision on interest rates. To be clear, markets fully expect them to leave interest rates unchanged. So maybe the bigger move might actually happen after, in about half an hour from now, when the ECB president, Christine Lagarde, she makes a press conference, and then she will kind of give an outlook for how the Eurozone economy is expected to fare, not just right now, but in 2026, and what they might do with interest rates. Okay, so cool. We'll see this right now, and I'll give you live data in less than 1 minute from now. Check out these super cool charting tools that we have. This is EURGBP 1 minute time frame. Okay, we'll see. Counting down now. We'll see. All right, here we go. Where is my chart? Okay, right, there we go. So moving now, EURGBP to the upside. That means the euro is strengthening against the British pound, or really just unwinding some of those losses that we saw in the daily time frame. But of course, ECB leaving its interest rates unchanged as widely expected. But still some slight recovery there. Nothing huge, not a big shocker there. Because again, as we had written from last Friday, we had said the European Central Bank is not expected to change its interest rates basically from now till the end of 2026. So a small move there. Okay, at least we kept it in check just in case there wasn't a big shocker. But maybe the bigger move might come in 14 minutes from now with the US inflation data, and then also after that with Christine Lagarde's press conference. Okay, let me just double check to make sure there's. Yeah. Okay. Cool. So yeah, doesn't feel like there's any big shocker coming out of the ECB. Okay. Cool. I'll go straight into the USCPI. Right. We got to keep rolling. So much to look out for. Now, if you are new to this, here's how this works, why the US inflation data due in about 14 minutes from now is so important. Okay. Now, first things first, the Federal Reserve is the US central bank. The ECB is the central bank of the Eurozone. The BOE, Bank of England, is the central bank of the UK, right? Now, the Federal Reserve is the most powerful, most influential central bank in the world. And they've got one job, which is to manage the US economy. But that one job is split into two goals. Okay. One, you've got maximum employment. That's why Tuesday's jobs report often, gathers a lot of attention from traders and investors worldwide. But then the second part of that goal, that mandate, is stable prices. And so that's inflation. Now they have a target, right? What is stable? They have a target of 2%. Okay. Now, to be clear, the Fed's preferred way of measuring inflation is actually called the PCE, right? Which is personal consumption expenditure. But that one comes after the CPI, which is happening in about 30 minutes from now. Okay, CPI, Consumer Price Index. Now, this is the headline inflation. So from the CPI numbers, you can kind of get a good read on what the PCE, which is the Fed's favorite way of measuring inflation, which comes out later. You can get a good idea of that from today's CPI, right? So that's why, again, markets are forward-looking. Markets are greedy, right? We cannot get enough information. So they're always wanting to know what's next. So this CPI coming out in 12 minutes from now, even though it's not the favorite way of measuring inflation for the Federal Reserve, the world's most important central bank, but it still gives us a very good read on where inflation is in the world's largest economy, which is the US. That is why it's so important. Okay. So here's how this works. Okay. So stubbornly, I made a typo there, sorry. But stubbornly high inflation, okay, the Fed keeps, this is an old slide. Sorry, let me just update this real quick. Sorry, folks. So stubbornly high inflation, the Fed will then keep interest rates high, i.e., they may not cut as fast as possible, cut interest rates, right? As opposed to lower than expected inflation, okay? And then the Fed may lower interest rates to try and boost inflation so that they can keep their 2% target in check. Okay, that is their definition of stable prices. So I'll just show you this to you again, right? So stubbornly high inflation, the Fed's recipe for curing that, right? If it's much higher than 2%, the Fed will keep interest rates high or even raise interest rates to kind of bring down inflation. Okay, I won't go into the details of how all this works, or maybe I can. I'll try and do it in 30 seconds. Okay, the idea is that when interest rates are higher, people have less money, right? Because people need to pay higher interest on their home loans, on their car loans, right? They got to pay more interest on all whatever money they borrowed. So the money that goes back to paying the interest, they can't use that same money to spend in the economy and drive prices higher, right? So when businesses realize, hey, my customers do not have as much disposable income, right? So they might not be so bold to raise prices, right? Raising prices is inflation, right? So if they only raise it slightly, maybe 1% per year, that's slow inflation or manageable inflation. Okay. So as opposed to when inflation is not hitting at 2%, right? Then the Fed will lower interest rates, push more money into the economy. Businesses have got more money to hire workers. The workers got more money. There's more money. There's more people with more money in the US economy. They can keep spending. Then businesses will be confident to raise their prices, hopefully by 2%, according to the Fed, right? So that's a sign of a healthy economy. Okay, so that's how interest rates work with inflation. And basically, the opposite is true for the jobs market. If there's too many people with too many jobs, with too much money to spend, that pushes inflation higher. The Fed then raises interest rates. As opposed to if there are people who are struggling, the US jobs market is weak, the Fed will lower interest rates to help businesses keep more of their money so they can hire and more people can spend their money in the US economy. Okay, so that's how the main way that the Fed uses to manage the US economy. The main way is interest rates, adjusting interest rates. So because of this dual mandate, and one of them being inflation, the Fed will then make the decision about what to do. So even though the Fed decision, the next one isn't due until January 28th, we just had one last week where the Fed lowered interest rates. That was widely expected, but markets are looking forward already, right? So they use this CPI data, they use this inflation data to kind of predict what the Fed will do in January. Okay, so right now as we speak, markets predict let me see. Let me give you some live numbers here. Only about a 1 in 4 chance, right? About 27% chance that the Fed can actually cut interest rates in January. But those odds become greater than half by March of 2026. 64% chance that the Fed could cut interest rates again in March. But it depends on the CPI data, right? Not just today, but also the one in hopefully mid-January, unless there's another US government shutdown. But based on these inflation data, then the markets will kind of predict what the Fed will do on January 28th. So if today's inflation data comes in lower than expected, so closer to that 2% mark, then the Fed may be allowed to lower interest rates again by January, right? Because maybe the jobs market has been showing some weakness, like we saw on Tuesday, right? So that's the kind of thinking that we'll have going into the CPI data release 8 minutes from now. Okay, so here's a quick look of how markets have reacted to US CPI releases over the past year, right? So I've highlighted some big assets: gold, S&P 500, and Bitcoin. And then after this, we'll look at some. Well, if I can try to do some forecasts for you, but if you got any questions, yeah, let me know. Okay, I see some chats here. Hi, Maverick. Yeah, sorry, man, Maverick. I've been missing some of your chats here because, again, too many screens. So I have to make sure I have my YouTube chat open. Well, the question is actually, would you recommend the tokenized versions of gold and stocks today as opposed to the actual thing, especially for someone in a third world country? Well, to be clear, I cannot give you financial advice, right? So please, we certainly speak to a global audience, and we've got licenses, in many different parts of the world. So please, for your local rules and regulations. So it really depends on. I think the tokenized version, maybe it's less about um, the differences between the asset classes. Is more about what's available in your region within the Bybit universe. Okay, so maybe that's a short answer I can give you right now. None of this is financial advice. Okay, so no recommendations here. See what's available. But the good thing is, okay, I'll go to the charts real quick. So if you look at these charts, right? So we have within the Bybit universe so many different products, right? Let me zoom in here. For those of you using the app, you can use the search box across the top and just type in whatever assets you want, or again, play around there. But for those using the Bybit website web trading terminal, you've got the hamburger menu in the top left hand corner. There's the 3 lines, horizontal lines. Click on it, and then you can see spot cryptos, so many different kinds. We've got X stocks as well, which is what Maverick on YouTube is mentioning about. You got perpetuals as well, futures. But guess what? Even within even within this universe, you've got things like a TradFi, right? Which is where we've got EURGBP, which is the chart that we just showed you earlier. EURGBP, yeah, big spike. Well, not a huge spike, only about 10, let me see, 7.5. Yeah, about 10 pips or so, right? 10, 12 pips, right? It may look huge on a 1 minute time frame, but if you zoom out to the 1 day time frame, not a big move there, right? So as you can see, still, this is the 1 day time frame. Still looks like what it was before the live stream, right? I got to zoom back in again. But we do have TradFi products like FX, right? Here within the Bybit universe, we've got quick check-in on S&P 500 right now. This is the 1 minute chart, right, for S&P 500. This is a stock index, the world's most popular, arguably the most popular way to measure how US stock markets are doing. We've got gold, which is right here. In fact, I got to zoom into the 1 minute chart. Thanks for the nudge there, Maverick. I will quickly prepare my charts here. Yeah, so 1 minute chart on gold, that's already done. We'll wait for CPI coming out in 4 minutes from now. Oh, and I haven't covered yet. So, anyways, all that to say, right? We've got all kinds of different products: TradFi, crypto, derivatives, right? So, check out what's available in your region based to local rules and regulations. Okay. Um, yeah. Okay. Cool. So that's EURGBP. I forgot to mention this. Okay. So for those of you, again, you want to check out all that we have written in the lead up to such a big event, head on down to bybit.com. Right, you see the Learn tab across the top. Click on Bybit Learn. For those of you using the app, sorry, I did mention this earlier. You go to your account, right, which is the top left-hand corner. You see the icon for your face there. Click on it. Then you'll see Services. Under Services, look for Learn, and then you'll come to a page like this. Okay, but those of you who went to bybit.com, click on Learn across the top. Click on Bybit Learn. Then you see the URL change to learn.bybit.com over here, and you get to this page. Scroll down both on the app and on the website, click on analysis, and then you can scroll down to our daily bits, which we just published. Okay, so you can look for the one that we wrote yesterday in the lead up to today. Okay, so recall the CPI figures that markets are basing their expectations or are on here. Okay, 3.1% year on year versus 3% for core CPI. Okay, so that's so when the official numbers come out in 3 minutes from now, okay, if it's higher than 3.1%, that means inflation is higher than expected. That means the Fed may not be willing to cut interest rates in January or maybe not even in March of next year because they got to make sure inflation cools down. How do they cool down inflation? By keeping interest rates high, right? And same thing with the core CPI. That's another way of measuring the consumer price index, right? 3%. It just strips out some of the more volatile stuff like food and energy prices. In case you didn't know, prices at the pump and gasoline in the US, right? It basically is adjusted on a day-to-day basis. I spent 8 years there in America. Back then, when internet wasn't so big yet, we were still, hunting for the places with the cheapest petrol price or gasoline price for the day so that we can all go get it, right? But anyway, so that's energy prices. They are more volatile. They move on a daily basis. Food as well. So this is perhaps a cleaner read on inflation. Okay. Within that index, so just remember, an index is just a way to measure something. Earlier, we showed you the S&P 500. That's a stock index. It measures a group of stocks. Okay, so S&P 500 is an index that measures 500 of the industry leading names. You're talking Apple, Tesla, Nvidia, JP Morgan, Walmart, Coca-Cola, McDonald's, etc., right? So all these big names. So that index measures how that group of stocks perform. Consumer price index, the index measures consumer prices, or specifically the changes in consumer prices. So right now, economists predict 3.1% for the headline CPI and 3% for core CPI. So if it's above or below, then we can see some market moves. Okay, coming out in about 1 minute from now. So maybe for that one, we'll look at, let's go down to gold. Gold is right here. We've got the 1 minute chart set up. Okay, we'll see there's a big spike in gold prices right now. In fact, shouldn't have cleared my voice in the mic. Apologies there, folks. Lots of multitasking to do here. 1 minute chart. Hopefully you guys can see this. Again, this is gold 1 minute time frame. Okay. Oh, big jump there. Okay, because we got the numbers that just came out. Here we go. All right. So CPI, whoa, way lower than expected. Okay, way lower. So remember, the expectation was 3.1% for CPI. It came in at 2.7%. 2.7%, right? Core CPI forecast was 3%. Actual number 2.6%. Okay, I'll actually put this up on the screen here so you guys can see it. Just gotta create another banner if I can. Sorry. Right, so you can see big jump there in gold. Why? Because gold prices love the idea of US interest rates coming down, right? 2.7% for headline CPI, lower than 3%, 3.1% forecast. Core CPI actual is 2.6%, lower than 3% estimate. Okay. So there we go. Okay, so I'll add the banner and I'll show it to you right now. Okay, so those are the official numbers there. Okay, so and here's a question that we addressed even from yesterday. Oh, I got to zoom because the move up was so big, right? So I have been getting questions from the live stream about, hey, what kind of time frame should I look at, right? So there are again, none of this is financial advice. You can simply cut into three phases. Okay. So number one, right, you got to get in before. Now, of course, some people get in the days and weeks ahead in advance, but whatever it is, whatever time frame you get in before. And this one is riskier, right? Because you have to guess which way the CPI will come in, right? So right now we are seeing, the official CPI numbers came in lower than expected, right? That boosts the chance of Fed rate cuts in January, or even for all of 2026, right? So gold went up. Now, if the official numbers had come in, sorry, if the official numbers had come in higher than expected, that means the Fed may not be allowed to cut interest rates in January. Then we could have seen gold going down, right? So phase one will be you get in before, and it's riskier. You gotta hope that the official data comes out the way you expect it to. Okay, that's number one. Now, number two, right, is what we saw just for a brief minute there, right? So after a big sudden move, you often see a pullback. Now, of course, this has its own risk because then you got to know when to get in and when to get out, right? But that's a very quick scalp, basically. You can Google more about this scalping, right? So this will be a very quick move. So you're seeing maybe a slight pullback here. You hope that you had put in a short position or sell order up here and caught some of this. There we go, right? So for the next few minutes, you're seeing this pullback as expected after you see this one big candlestick here. Now, phase three will be then longer term, right? You wait for the dust to settle and then you think, okay, based on this CPI data, I'm more convinced about the Fed cutting interest rates in January 28th. Okay, then you have to also hope that the incoming data, right, be it the non-farm payrolls coming up next in January, and then the next CPI data as well, all of that supports this idea of the Fed cutting interest rates between now and January 28th, right? So that's more of a longer term. So you still have to take a directional view here, right? So those are the three oversimplified phases, each with their different risks. So the short answer is, which time frame should you select? It depends on your risk appetite. Either phase one before, right? And the risk is you hope that the official data or event happens the way as you expected. Or phase number two, slight pullback like you see in the screen here. Or then phase three, longer term. Okay. Of course, there's so many other variations, but I'm just giving you a simple one, right? But right now, gold still elevated because of that lower than expected data that we saw for USDJPY. Right? We just came out 4 minutes ago. If you're just joining, 2.7%, right? That's the consumer price index, which is the headline way of measuring inflation. That is lower than the forecasted 3.1%. Core CPI, which excludes energy prices and food prices, which are more volatile, that came in also lower at 2.6% compared to 3% as expected. Okay, let's check on gold. Let's see how Bitcoin is performing right now. This is the daily chart. I'll see what the 1 minute chart looks like. Zoom in. Yeah, maybe not as reactive as well, but see, it's still higher than it was before, right? So again, assets like Bitcoin, S&P 500, and we'll show you that in just a bit, right? These assets, gold, Bitcoin, stocks, they love the idea of US interest rates going down. So with lower than expected inflation, right, the Fed may be allowed to cut interest rates in January. So they are reacting already now, even well before, way more than a month before the Fed is actually doing anything. Why? Because markets are forward-looking in nature. Today's prices, the prices you see on the screen right now, reflects tomorrow's hopes, right? January 28th hopes. Right? So right now, Fed funds futures not moving much right now. Market's still expecting a 27% chance that the Fed can cut interest rates right now. But that's another contract, right? Right now, you're seeing some live reactions in gold, Bitcoin. Let's go to the S&P 500 right now. Let's see where it's at. But to be clear, here we go. So another big move on the 1 minute candle, but then see phase two, right? We're now in phase two, this pullback here. You see this very often. Okay, but to be clear, this is the S&P 500. But to be clear, right, once I zoom out to the daily time frame, these moves aren't that big, right, in relation to everything else. Well, I really got to zoom out here. Right now, to be fair, okay, at least the S&P 500 on the daily time frame. This is the daily time frame. It's erasing some of its losses that we saw from earlier today, or actually, no, erasing its losses from yesterday, right? But now, oh, beautiful, being resisted at this green line. What is this green line? This is the 50-day simple moving average. It is a very widely followed technical indicator. You can pull up these indicators basically across many different asset classes, right? But the 50-day simple moving average is basically one of the textbook moving indicators, technical indicators that people follow, right? Have I already highlighted this? Bam, let me just edit this. So resistance, okay? When I say resistance, think of a ceiling. That means prices hit it and then bounce back down, and that is exactly what has happened with the S&P 500, even as we speak live, as the CPI data just came out. Okay, so yeah, that's on the daily reaction, not a huge amount, right? But if you look at the 1 minute candlestick, if you are trading at these smaller time frames where it's riskier, right, the move, the post CPI move is more notable there. So big spike, pullback, now coming back up. Okay, perfect. Textbook. Phase one, get in early before the event, and you hope the event goes out the correct way. And this is where, again, proper risk management is so important. Yeah, gotta make sure that you have the stop losses in place as well, because otherwise, if you don't have enough margin and it goes totally in the opposite direction, then yeah, you could be margin called, depending on what kind of account type you have. Okay, and whether you got enough of a balance, enough margin. But yeah, big spike up, phase one, phase two, pullback, and then we'll see. Looks like maybe this pullback is over. Markets are, quite happy with this narrative that, hey, the Fed is maybe likelier to cut interest rates in January because hopefully inflation is coming down now. But Fed funds futures still predicting a 26.6% chance of a rate cut in January, pretty similar to what we had before this CPI data. So that's a live look at the S&P 500, right? That's a live look at Bitcoin there. Yeah, I'm bouncing higher, back above 88,000 now. All right. But again, if we go back to the 1 day chart, sorry, folks, I know I have to jump around quite a bit. Still very much in this sideways trend. This is Bitcoin on the daily time frame, still very much in this sideways trend that we have seen since mid-November or November 21st or thereabouts. Yeah, mid-November, right? Resisted at the 21-day simple moving average. This is on the daily time frame, right? Resisted, think of ceiling, hits it, comes back down, did it again on December 15th, December 12th, December 15th, and again yesterday. Today, we'll see if we can get up there, right? So for those technical traders who are looking on the longer time frame, on the daily time frame, you're going to want a daily close above the 21-day simple moving average for it to be a potential signal. It's not the be all end all, but it's a potential signal that, Bitcoin could move higher. But look, and I've been saying this in my daily live streams a lot, and I'll say it again. I think Bitcoin and cryptos in general will kind of struggle basically between now and January 15th as a big decision due by then. Could happen before January 15th. But, until then, crypto markets are contending with, some news that could either see a big jump up or a big move down by January 15th. Okay. Let me just zoom back out to the S&P 500. Yeah, so resisted at the 50-day simple moving average. Again, this is the 1 day time frame. Bam, testing it. If you can break above it and secure a daily close, that can be seen as a bullish signal. Bullish meaning prices could go on higher from here. That's the kind of signals that technical traders rely on. 50-day simple moving average is very widely used, but again, please do your own research because you got to get confirmation from other things. Like, I think the RSI is behaving quite well right now. MACD, so many different indicators that you can find within the Bybit web trading platform. Just click on the icon in the top left hand corner that looks like a chart, and this pop-up will show up indicators right there. Okay, you can type in what you want or just keep scrolling down to find different ones, or you on the Bybit app, you can find these indicators in the settings icon. The settings icon is like this, nut and bolt looking like icon that you can click on, and the indicators are there. But yeah, right now, S&P 500, US stocks, gold, Bitcoin, as predicted. This is the Nasdaq 100, which is another stock index. Right, just really loving the idea of cooling U.S. inflation, and so that's why it's going up. Similarly, Bitcoin. This is gold, right, on the 1 minute chart, up, slight pullback, going even higher. Okay, so which brings us back to this, right? Before we wrap things up, we asked the question at the start of the week. Okay, can gold hit a new record high? We asked this question on December 15th, which is Monday, right? So we will now look at it on the daily time frame. You still have got about $50 more to go. So even though it looks like a lot on the 1 minute time frame, again on the 1 day time frame, not much. Erasing today's losses. Let me try and adjust all this. Yeah, folks, I know I'm moving fast. Your record high is all the way back here around mid-October of 4381.44. Right now, erasing today's losses. But we'll see, right? We'll see if, let me move this away. We'll see if this narrative of the Fed being able to cut interest rates can be sustained between now and into the weekend, and potentially hit a new record high for gold prices. Okay. That's the setup right there. Let me just change his color real quick. There we go. 4,200 there. Yeah, lots to adjust on the charts when I'm zooming in and out like that. Hope you guys are able to follow along. Thank you for the questions there. Yeah, thanks for the comments there, Maverick. Well done. So yes, I am in the UAE. He's asking me where I am. I am in the UAE, and economics 101 lesson. Yeah, I know. Happy to share, buddy. So let me do a quick check-in on Twitter X before I wrap up. Let me see here. Can't really see any comments there. It's a bit tough to see the live chat. Yeah, bear with me here, folks. So many tabs. If you only could see my setup here, so much to look out for. But yeah, if you're missing it, again, CPI coming in lower than expected. So you've got gold erasing today's declines on the daily chart. You've got S&P 500, building or now punching above, right? But again, this could be false. We're going to see if there's a daily close above the 50-day simple moving average, this green line here. And that could be a bullish signal, but clearly rejoicing after that lower than expected CPI, and Bitcoin as well. Ooh, now testing the 89,000 big round number. That often acts as either support or resistance. So if you missed my explanation earlier, resistance, think of ceiling, prices hit it and come back down, like we saw initially for the 50-day simple moving average on the S&P 500. Resistance hits it, comes back down. Support, think of a floor, right? Hits it, goes back up, rebounds. Okay, yeah. So lower than expected US CPI, Bitcoin, S&P 500, and gold, Nasdaq 100, all clearly rejoicing in these assets. Maybe a quick check-in on another one that we're looking at, or silver. No surprise here. Silver on the daily chart has just been posting a new record high basically every single day of this month. You've only got 1, 2, 3 red candles. Everything else has been higher. EURGBP, let's see where we're at right now. Yeah, not much happening on the 1 minute time frame. Beyond the spike here after the ECB decision. Oh no, this was CPI, sorry. It's a big spike here, but otherwise not much. Because again, this is the US inflation data, right? Less pertinent to what's happening between Europe and the UK, right? That's why you got EURGBP. Yeah, so looks like this setup might be a big ask, although we've got a pretty decent track record of many of these I shouldn't say forecast, but potential trade setups that have actually been fulfilled, right? But this one is still stuck in the middle because of this push and pull between US jobs data on Tuesday, UK inflation data on Wednesday. Today you got a trio, right? You not just have the ECB, you've got the Bank of England rate decision earlier today, and then now they just landed about 15 minutes ago. The US inflation data. But still, we'll zoom in on the 1 minute chart because I believe you've got the Christine Lagarde, who's the president Yep. So she's going to be speaking here shortly. And what she says about the state of the Eurozone economy, right? If the inflation is looking stable, or maybe inflation risks um, moving back up. So if that happens, then who knows? And there's already talk about the ECB maybe even having to raise interest rates next year, right? So if that idea holds, I won't be surprised if euro strengthens against the British pound, and then you've got euro GBP going up. Okay, a currency tends to strengthen at the thought of its economy's interest rates going up or at least staying higher than someone else. Okay, so as opposed to if a currency tends to weaken, go down when it's at the idea of its economy's interest rates going down. Okay, that's how it works. And then you compare those two against the currency pair that you chose. So Europe versus GBP, or if you're doing euro dollar, EURUSD, which is the world's most popularly traded currency pair, then you got to see what the interest rate outlook is for the Federal Reserve in the US versus the European Central Bank. All right. And their press conference is about to start right now, but you can go check that out on YouTube. I believe they do stream it live there. So there we go. There is some live market reaction to so much happening. Wow, this was a jam-packed 45 minutes. Maverick, sorry, I missed a question. You're asking why is that? Why is that on what? Sorry. Is it on the currency reaction to interest rates? Because if that's the case, I don't mind staying on while we watch EURGBP react to what Christine Lagarde says. Christine Lagarde is the European Central Bank president. If you're still there, maybe I'll give you one more minute to clarify why is that question, what is that in relation to. So much for the forecasts. Are there other assets that we can look at? Maybe this is oil. Yeah, maybe not so much here. We'll just do a quick check-in. So you do have even oil available within the Bybit TradFi universe. So even though Bitcoin has been moving sideways, right, since mid-November, but you've got silver spiking up to a new record high. S&P 500 also just hit a new record high last Thursday before then coming down, now rebounding in the wake of that lower than expected US inflation data. Okay, so the question from Maverick is, why do currencies weaken with lower interest rates? Okay, great question. So, why do currencies weaken with lower interest rates? Okay, great question. So, let me try and give you a simple and short answer. So, as investors, right, they want higher interest rates generally. Okay, I mean, that's an oversimplified statement because if a country has high interest rates, that means there could be more risk there also. But just generally, investors like higher interest rates, right? I mean, you think about it. If you deposit money in the bank and you want to do a fixed deposit, you're looking for which bank can give you the higher interest rates on your deposits, right? So same thing with government bonds and all that kind of stuff. So the idea that when interest rates go up, okay, and remember we always say they are benchmark interest rates. What does it mean? That means banks, like in the US, they measure their mortgage rates, right? How much interest to charge people who lend money from them to buy houses, right? Those interest rates, that's all benchmarked against bond yields, and then bond yields often follow where the Federal Reserve or the central bank puts interest rates, right? So anyways, all that to say, higher interest rates tend to promise more returns for investors. So if I know that a country is offering me more interest rates to buy their government bonds, I'm going to send my money there, right? So, for example, Japan's 30-year bonds hit a record high. Japan's 10-year government bonds, I think it's at its highest since 2007, I believe, right? If you don't believe, we actually wrote about this earlier today as well. For those of you just joining or still with me, I'll show it to you again. Head on down to bybit.com. You'll see the Learn tab. Click on Bybit Learn, and then you'll see the URL change to learn.bybit.com, or you can just type in learn.bybit.com yourself. On the app, you go to your account, top left-hand corner, click on services, look for Learn, and then you can find this same page here. Scroll out to analysis, and you can check out this article that I published today. And this is okay, good for us to talk about this because now that CPI is done, markets are still digesting it. We look ahead, right? We look ahead to tomorrow. How might Japan's events affect all this stuff? Okay, so you look at Japanese government bond yields. I got a chart all the way down here. Okay, Japanese 30-year government bonds yields hit a record high. Oops, sorry, right? 30-year Japanese government bond yields hit a record high right there. Okay, this goes all the way back to before the year 2000. This chart, 10-year JGB just means Japanese government bonds. Their yields. That means if you were to lend or buy a government bond today from the Japanese government that's going to expire only 10 years from now, you can get the highest yields since 2007. Right. So again, higher interest just is more enticing for investors. So if I know this is happening in Japan, I'm going to send my money into Japan. I need to buy Japanese yen. I need to buy Japanese yen to buy their government bonds, right? So when there's more buying of the Japanese yen strengthens. So all that said, right, the idea of interest rates going up and potentially yields going up as well tends to strengthen the currency. Okay. I think I did a pretty good job in 8 minutes. Wow. I mean, that's a whole econs lesson right there. Or actually, finance. Econs, finance, both, right? Monetary policy, that's what central banks do, and how financial markets react to it. Okay. So hopefully that answers your question there, Maverick. So for those of you following along, the idea of interest rates going up strengthens the currency. Why? Because interest rates going up, bond yields go up, they are more attractive to investors. Hey, I want to buy the government bonds because they are giving me more yields now. So I send money into the country, I buy the currency. More buying of that country's currency means their currency strengthens. Okay, that's the oversimplified, very short explanation there. Yeah, happy that you like it, Maverick. Okay, cool. So we'll end it there. I don't want to go through a whole hour. Oh, so much going on. Bitcoin right now, right? Some live data here, testing, not just a psychological, 89,000 level that we see right here. That's the red line running across 89,000, hitting it. You've got a lot of resistance there. Also, you've got this purple line. That's this upward. Here's another way you can do charting 101 here. There's some very simple charting that you can replicate on the Bybit web trading platform and on the app as well, right? So you got this rising trend line here, right, where support, that means prices hit it, then bounce back up, support, bounce back up, right? Then it broke below it. So now this support has become resistance, right? And we've seen that all of this week. On Monday, December 15th, hits it, comes back down. Tuesday, hits it, comes back down. Wednesday, hits it, comes back down. Right now, as we speak, hitting it right now as well, testing it. Can it break through? We'll wait and see. So technical traders on the longer time frame, this is the daily time frame, we'll be seeing, okay, first, can it break above this big round number, 89000? Right? You will see this very, very often. Big round numbers have this psychological impact on traders, right? Because not just is it easier to type in the number in your order forms, but then also it's a psyche. You got to answer the question, is Bitcoin worthy of being priced above 89,000 right now because of the CPI number that just came out, right? That's more of a fundamental analysis. Although fine, you can argue there's no fundamental analysis for cryptos. It's good old supply and demand. But, just at least for other asset classes, those doing fundamental analysis, they got to ask themselves the question, is this asset, is this stock, is gold, is this index worthy of being above this big round number? It's just easier to compare, right? So that's why big round numbers can often impact the psyche. 89,000 offering resistance, think of ceiling, hits back down. For Bitcoin, this upward trend line also acting as resistance right now. A daily close above it, and keep in mind you got a 21-day simple moving average, this baby blue line here, right? Another widely followed technical indicator, same thing, right? Support back in early December, broke through, resistance, right? Even up until yesterday, hits it, comes back down, right? Can we see a breakthrough above all this strong resistance? 89,000, purple line, trend line, and then baby blue 21-day simple moving average. You got to break all above it before you could potentially see 95,000 again. It got close in early December, but see around 95,000, you got the 50-day simple moving average, and then you got another big round number there as well. Okay, but for now, for the very short term, Bitcoin clearly liking the lower than expected inflation. S&P 500 also trying to break above its 50-day simple moving average, and gold. Sorry, gold. Oh, I just closed my gold chart. No worries. I just got to hover over the hamburger menu in the top left hand corner, type in XAU USD, right? And it's got a plus sign there, and bam, my gold chart is back up. Oh, how about this, right? So maybe if we can conquer this whole region, it's back in the green right now. Maybe our ex- uh, potential setup of a new record high for gold could be achieved by the weekend, right? We'll see. We'll have to wait and see. We still got not just today, but also we've got Friday going into the weekend, new record high, only like about 1% away. Although we've got no big scheduled events. Well, and on Friday, we got a Bank of Japan. That's big, right? Watch Japanese bond yields if you like. You can Google it. Yeah, that's coming up tomorrow overnight. That's this stuff right here that we had highlighted here, right? Japan National CPI 11:30 p.m. UTC time tonight, and then 3 a.m. tomorrow. You got a Bank of Japan rate decision. So watch those. Gold could see a big move there as well. Okay, I think we'll end it there. Thank you so much for those of you who have watched until this whole time. Really appreciate it. If not, you can watch a recap. Again, our social media handles are, let me try and pull it up again. It is on YouTube. You just gotta search for Bybit Learn Official, and then you can tap on the live tab. In the name of transparency, all of our daily market update live streams are hosted under the live tab, or on X. It's oh, sorry, wrong one. That was from Tuesday. Here, there we go. Or on X, our handle is at Bybit_learn. Okay. We'll leave it there. Thank you so much for joining. And otherwise, tomorrow I'll see you at 2 p.m. GMT, and we'll do a wrap up of what a eventful week. If you've been watching this live stream, so much to cover already. What more the US jobs report that we had from a couple of days ago. Okay. Thank you so much for joining. Oh, one more thing. Sorry, I keep forgetting. Wow. If you have stayed until this time, well done you, because guess what? If you are a new user, you don't have a Bybit account yet, oh, do I have something special for you? Guess what? I've set aside a prize pool of 25,000 USDT in rewards to give away if you sign up now. All right. How do you sign up? First, you either scan the QR code, or you can click on the link below in our YouTube description, or you can find the link on our X account as well at Bybit_learn. They're all over our feed. You just got to scroll around. It's even in the description for today's video, today's live stream on X, right? Scan the QR code or click on the link, and then it will land you on this page, which is over here. You got to, usually the sign up button is on the top left hand corner, but of course I've got an account already. Otherwise, if you are an existing Bybit user, same thing, scan the QR code or click on the link, and then you can have your share of a separate prize pool of 5,000 USDT per week. How do you do that? You just scroll down and you can complete all of these different tasks, right? Either engage with our content or deposit, trade, invite friends, and then you can stack yourself up against these other guys who have already taken advantage of the weekly 5,000 USDT rewards that we have for them. Okay, so that's for OG users. For new users, sign up now, scan the QR code or click on the link. You have your share of 25,000 USDT in trading vouchers to be given away. We have been giving them away throughout these live streams. We've got only a couple more days left, so do not miss out on that. So then once you've signed up, once you have gone through the whole process of registering, then you can be in the running for an additional 5,000 USDT prize pool by doing all these same tasks as well. All right, cool. We're at the top of the hour. Thank you so much for all those who are joining right now. Don't forget to sign up. I'll show you again. Scan the QR code, click on the link below. If you're just joining, rewatch the whole live stream so that you understand how FX markets, gold, Bitcoin, stock indices, how they react to important data like the US inflation data, which just came out half an hour ago. Okay, cool. I'll see you tomorrow, 2 p.m. GMT. Thank you so much, and